The dot-com bubble is quite possibly the most infamous speculative bubble in financial history, and its collapse left behind a countless number of failed tech startups. These failed businesses are notorious for being incredibly unprofitable businesses that sold investors on nothing but hype and empty promises. But in this graveyard of failed dot-com companies, there's one company in particular that stands out from even the rest of its peers as the face of everything that went wrong with the dot-com bubble. A company that was so fundamentally flawed that it would go out of business just 9 months after its initial public offering on the stock market. And that one company is Pets.com. Pets.com was founded in San Francisco in 1998 as an online pet supply retailer that aimed to revolutionize and disrupt the pet industry by offering a convenient and accessible online platform for pet owners to purchase pet supplies. With the speculative fever surrounding online companies during this time, this vision alone was enough to land the company significant private investors with deep pockets. Amazon.com even purchased a majority 54% stake in Pets.com in the company's first round of venture funding. Even back then, Amazon was very influential in the e-commerce space, so Amazon's backing of Pets.com gave the company additional credibility and notoriety in the public eye. Flush with cash from investors, Pets.com then began an aggressive marketing campaign to expand its customer base. With a memorable sock puppet mascot and a high-profile marketing campaign, the company quickly gained recognition and generated substantial buzz in the media. The sock puppet mascot was a home run for Pets.com and became incredibly popular. The sock puppet's popularity landed at appearances on numerous shows, and the company even managed to get a balloon in the 1999 Macy's Thanksgiving Day Parade. As if this wasn't enough, the company also splurged on a $1.2 million Super Bowl commercial in January of 2000. Pets.com would then take all of this marketing momentum into its initial public offering on the stock market just 1 month later. The IPO was met with tremendous enthusiasm and raised $82.5 million for the company, in one of the most highly anticipated and hyped IPOs of the dot-com era. But hidden beneath Pets.com's marketing strategy were fundamental business flaws that would contribute to the company's rapid downfall. Like many other companies during the dot-com era, Pets.com had an unsustainable business model that just didn't work, and it was incredibly unprofitable. While the company's marketing campaign was successful in generating awareness, the company's marketing budget was also out of control. In just 1 quarter, Pets.com spent around $17 million in sales and marketing costs, but its revenue that quarter was around half that amount at $8.8 million. And that's not even factoring in the cost of goods or other operating costs. Even if you were to ignore the astronomical marketing costs, Pets.com's fundamental business model was completely broken. Pets.com faced intense competition in the pet supply market, both from traditional brick-and-mortar retailers and from other emerging online competitors. Established retailers such as PetSmart and Petco had already built a loyal customer base and possessed extensive distribution networks. And at the same time, other dot-com companies were entering the online pet supply space, hoping to cash in on the same opportunity as Pets.com was. These online competitors included names like Petstore.com, Petopia.com, and PetPlanet.com. And just based on the similar names of those other online competitors alone, you might be seeing one of Pets.com's biggest struggles. And that would be that Pets.com didn't possess any meaningful differences from the competition in the eyes of the public. So all of these online chains were seen as being relatively interchangeable and were often confused with each other. This inability to differentiate itself from online competitors was a constant struggle that Pets.com never really found a good answer for. But an even bigger problem for the company was that the brick-and-mortar competition possessed significant advantages over Pets.com in many ways. Not only was brick-and-mortar already established in the pet space, but Pets.com didn't have a whole lot to offer against brick-and-mortar. The value proposition for Pets.com was pretty weak, especially for the early 2000s. The reality of the situation was that pet food and other pet staples could be found easily at most grocery stores. And back in the early 2000s, e-commerce was just getting started and was nowhere near as popular with consumers as it is today. So many consumers preferred to buy their pet food at the grocery store while doing their regular shopping, instead of buying it online and having to wait several days to have it shipped to them. The convenience Pets.com offered with having pet supplies shipped directly to the customer was overshadowed by the fact that consumers would have to wait for them to ship, and the fact that pet supplies could just be found readily at most grocery stores. Even nowadays, with online shopping on the rise and e-commerce platforms like Amazon firmly entrenched in the economy, most consumers still prefer to do their grocery shopping in person at brick-and-mortar locations. A 2021 survey showed that 87% of consumers do most or all of their grocery shopping in person at stores. And if that's true today, it was even more true back then in the late 90s and early 2000s. So with pet supplies so readily available at grocery stores where consumers preferred to shop anyway, Pets.com didn't really have much of a value proposition to offer to customers. And because of all of this fierce competition, Pets.com was forced to compete heavily on price, even though this was a competition they couldn't afford to do profitably. Pets.com operated with negative gross margins on most of its products, and frequently sold products for less than what the company was actually paying its suppliers to get its inventory. Pets.com also offered free shipping for most products, which was unsustainable given the high costs associated with the logistics and inventory management, especially back then. For pet food in particular, it was extremely uneconomical to be shipping 30-pound bags of dog food for free. It's important to note that pet food and supplies are notoriously low-margin products that don't generate much profit to begin with. So even in the best-case scenario without all of these additional challenges, Pets.com would have been barely scraping by with each sale. So despite managing to grow its sales, Pets.com actually lost more money with every sale it made, since it had negative gross margins and unit economics. This fundamental issue with the business model meant that Pets.com was relying almost entirely on investor funding to sustain its operations, since the business itself could not. And investors were willing to do that for a while. But as the dot-com crash started in March of 2000 and the bubble began to deflate, investors grew increasingly skeptical of Pets.com's viability. The company's stock price plummeted from its IPO price of $11 per share to a measly 19 cents per share in around 9 months. To make matters even worse for Pets.com, it had spent most of its cash reserves on large investments like warehouses and shipment infrastructure. The company also used some of the money it raised from its IPO to purchase one of their biggest online competitors, Petstore.com, for $10.6 million in June of 2000. But Pets.com's spending spree left them with very little cash to sustain their unprofitable operations. In September of 2000, the company began trying to cut its costs by moving from San Francisco to a cheaper location in Indiana. But the cost-cutting initiative was too little too late, and cutting costs couldn't change the fundamentally unprofitable business model. With the writing on the wall, management made the decision to liquidate the company in November of 2000, and to sell the company's remaining assets and recover what little value they could. This sale included selling the Pets.com web address to its brick-and-mortar rival PetSmart. And to this day, the Pets.com URL still redirects to PetSmart's website. The fire sale of the company's assets was used to return what little value remained to its investors. But with the company falling from its IPO price of $11 a share to just 19 cents a share the day that it announced its liquidation, Pets.com investors still lost nearly their entire investment in less than a year. The downfall of Pets.com became synonymous with the excesses and overvaluation that characterized the dot-com era, and it was one of the most prominent casualties of the bursting bubble. While the company no longer exists, the story of Pets.com lives on today as an icon of the dot-com bubble and a cautionary tale about the dangers of stock market bubbles and irrational hype. Investors were lured in by the promise of rapid growth and the potential of dominating the online pet market. But the truth hiding in plain sight was that Pets.com's fundamental lack of a sustainable business model was an insurmountable obstacle that investors were overlooking. and it was a mistake that they paid dearly for when the dot-com bubble popped. Pets.com's failure is a reminder that successful companies are built on more than just hype and promises. They require a solid foundation grounded in a sound business model. Even though Pets.com did fail, the company's vision of an e-commerce-focused pet supply retailer is one that would eventually be successfully done a whole decade later by the company Chewy, which is now valued at over $15 billion. As time went on and the e-commerce market began to grow and the costs of running an online company began to decrease, it became more feasible to sell pet products online at profitable gross margins. So while Pets.com lacked a financially viable business at the time and was incredibly mismanaged, at least part of its struggles also came from simply being too early to the market in an era where e-commerce was a less feasible business model. But be sure to let me know your thoughts on the dot-com bubble and Pets.com in the comments below. And be sure to subscribe to the channel for more finance content. Thanks.